I really thought that seller financing was only beneficial for the buyer. And then it was until I learned about why it is beneficial from a seller's perspective because of taxes, inflation, and then I realized, well, I can actually pitch sellers on selling me their property using seller financing. A seller using seller financing is going to pay less in taxes.
Hey guys, welcome back to the podcast. I did a tax strategy bootcamp on how to use seller financing both from a seller side and from a buyer side, and I thought it would be great to present you those recordings from that bootcamp.
So seller financing, pretty interesting topic lately as interest rates are kind of remaining high. I think seller financing is a great way to acquire property. Also a great way to sell property too. I've done 3 deals, seller financed. I actually bought my second house using seller financing. I had bought, if you've gotten my emails before, I talk about like the first property that I ever bought was, I paid $2,500 for it out of my own pocket because I was able to get closing costs and negotiate with the seller. And so I bought my first house for only $2,500. But the loan amount was pretty high. And at the time I was only working a W-2 job and I wouldn't qualify for any other loans. And the seller who sold me the original house, what I didn't know at the time was that he was also selling 6 or 7 other houses in the same area, like the same zip code. And he asked me like, hey, do you have any interest in buying any of these other properties from me? And I said, I do, but I'm not going to be able to get a loan. Would you be interested in financing it to me? And it took a couple of breakfast meals to convince him exactly why seller financing was in his favor and why he should do that as opposed to just selling it traditionally. Now, I'm going to break down just a couple of basics. I'm going to talk about the pros for each side. So you got the seller, and then you got the buyer. So from a buyer perspective, there's going to be less transaction costs because the buyer is not going to have to go to the bank to get a loan. They're going to have less transaction costs. They don't need to have filed tax returns. So for those of you who maybe you bought a couple of properties, maybe your debt to income is too high. Like when you seller finance, they don't look at your tax returns. So you don't really have to worry about qualifying for the loan conventionally if you're using seller financing. I would say another benefit is also that your debt to income, right? So we're going to have Parker on later to talk a little bit about debt to income, but you don't have to worry about debt to income as a buyer of a seller finance property because the seller is loaning you the money. You don't have to qualify for it conventionally. And then I would say another benefit is just another benefit to buying seller financing is you could probably get a lower interest rate than if you were to go to a bank. When I first learned seller financing, I really thought it was only beneficial for the buyer, right? The buyer can come in and they have less transaction costs. I don't need to show my tax returns. I don't have to worry about my debt to income. I can get a low interest rate. I really thought that seller financing was only beneficial for the buyer. And then it was until I learned about why it is beneficial from a seller's perspective because of taxes, inflation, all these other types of things that we're going to talk about today. And then I realized, well, I can actually pitch sellers on selling me their property using seller financing. Now, the benefits from the seller are going to be, number one, we're going to just flat out say they're going to pay less taxes overall. Okay. We used the example yesterday for those of you that were here. Let's say a seller has a $100,000 gain. Well, if they just sell properly normally and they get $100,000 cash deposited into their account, they're going to owe 20% taxes on that. And then they're going to lose value to inflation, right? So a seller using seller financing is going to pay less in taxes. Another benefit is because you're receiving interest, the seller is going to be able to actually keep up with inflation on their money, because instead of that money sitting in their bank account not doing anything, it's going to be receiving interest payments, and it's going to keep up with inflation. Arguably, too, with seller financing, there's some deals. Sometimes people own properties that you can't sell conventionally because no bank is going to give somebody that loan. So, for example, I forget who I was talking to the other week. She's part of the 365 tax strategy, but she had a deal where the seller, they were just showing really bad net income numbers on their tax returns because they were just funneling a bunch of personal expenses there. They were collecting a lot of money via cash, so that they weren't reporting it. So the sellers had terrible financials. And so no bank is going to loan conventionally or commercially on terrible financials. So sometimes it's in a seller's best interest to sell a property using seller financing because they know that no bank is going to come in there and actually give the buyer a loan regularly, right? So they're pretty much forced to sell a property using seller financing. So pay less in taxes, keep up with inflation. I would just say more deal flow, in a sense that they're going to have more people that are interested in seller financing than a regular conventional loan. I would say the other pro to this is, let's just call it the next best opportunity. Next best opportunity. And what I mean by that is, for sellers that are approaching retirement age, if they're going to get a windfall. So I've done this twice now, where you got a mom and pop seller, let's say it's a campground, a rental property, an RV park, a business, and they're getting towards retirement age. Well, let's say you're 50 and you get $1 million that hits your bank account. That's your entire life net worth right there. Is all in that business. If you're 50, 55 and you're about to retire, you don't have a long time horizon for that $1 million to work for you. Like, sure, you can take that money, invest it in the stock market, but you don't, in my opinion, 10 years is not a long enough time horizon to be investing in the stock market. Instead, that person's better off getting a fixed income through those interest payments, through the principal payments of a seller finance note, versus having to kind of pull the slot machine and have that money work for them in the stock market. So it could be their next best opportunity. Instead of having that money, like we talked about earlier, sit in a bank account and, again, get taxed, lose value to inflation, it might be their best opportunity to seller finance you the property, and you start paying them interest and principal payments. Now, there's all these different types of ways you can work into a seller finance deal, but I would show you practically kind of how this works. So it's going to take some getting used to, like knowing the seller. If you're trying to buy a property using seller finance, it's going to take you getting used to the seller and understanding what their goals are with the proceeds after they sell the property. And this isn't something you just go and pitch to every single person. But the right way to really do this, and I've seen this done a few times now, where what you want to do is, if you're really serious about a property, is you want to present them 3 different offers. And you could do this in what's called like a LOI, a letter of intent, or you can put in a contract like 3 different offers, right? The three different ways that you might approach it is, you might have a all cash offer. Let's just say for numbers' sake that the deal, the purchase price of the asking price of the property is $500K. And you go to the seller and say, hey, I'm willing to give you an all cash offer for $430,000, something like that. Something like a discount, maybe $450. I'll give you all cash, $430. I have a second option where I'll do a conventional loan. I'll do conventional 20% down, and I'll give you your asking price. Okay. So why would they do one or the other? Well, if it's an all cash offer, they know it's more guaranteed to close. They don't have to wait on a bank for an appraisal, and it's going to move quicker versus if you get a conventional offer, you're going to have to wait on the bank to appraise the property. The property has to appraise for $500K in order for that borrower to get the funds. So a seller might take an all cash deal as opposed to a conventional deal in certain scenarios, especially if this property is like a business or an RV park or a campground and they don't have the financials to support that $500,000 price. They might have to sell it with some sort of either an all cash offer or number 3, seller financing. Because you might go to the seller and say, hey, how about this? Instead of me giving you $500,000, I'm going to give you $520,000 or $550,000, but it's going to be on my terms. So I'm going to give you $520,000, and I'm just kind of making these numbers up, but this is kind of how it would look. Like, I will give you more than your asking price, but here's the deal. I'm only going to give you 10% down. And so I'm going to put $50,000 cash in your pocket today. And then I'm going to pay the rest off over 10 years. So 10 years, I'm going to pay the remaining $470,000 that I owe you. And we said earlier, like, why would a seller want to do this? Well, they might take this offer because they can't get any of these other competing offers. No bank may want to loan them, or no bank may want to loan on that property, and maybe somebody doesn't want to pay all cash for it. So you might be able to present them a seller finance offer where you're putting a little bit of money down now and you're paying them the rest over. Typical seller finance normally is like 5 to 7 years. You could do 10 years. You could do anything you want, really. But why would the seller do this, right? So number 1, that's the only way they can sell the property. Only way, through seller financing. Number 2, remember we talked about taxes. So assuming that the person owned this property for their entire life, they're probably going to have a $500,000 capital gain because they fully depreciated the property down to 0. And if they're in a 20% tax bracket, well, as soon as they receive that $500K, they're going to send $100,000 of it away to the government in the form of taxes, right? And then they're going to lose value to inflation. And if they don't invest in something else, they're going to lose purchasing power. Number 3, we talked about earlier, inflation, right? If they sell the property with an all cash offer or a conventional offer, sure, they get the money in their hand today, but they're paying taxes, they're losing value to inflation, and now they're not out earning inflation unless they have to reinvest the money. But if they're close enough to retirement age, remember, they don't have enough time to invest that money in the stock market. They have to get a guaranteed fixed income stream. So maybe they're willing to loan you the equity that they are leaving off the table. So instead of getting $500,000 in their bank account, they're only going to get $50,000, and then you owe them the $450 or $470 over a period of 10 years, 5 years, however long you want to do it. And so then the 4th reason would be that opportunity cost, right? Well, this might be their best investment moving forward, is to take that guaranteed note, that 5%, 4% rate, and as opposed to investing that in the stock market. So, whose name is on the title with seller financing? So as a buyer, you're going to take title on the first day or when you buy at the closing table. Now, typically within those seller finance deals, there's going to be some sort of contingency of a default period. So if you, the buyer, don't make the payments, sometimes it's like as short as like 3 months in default. Like if you go 3 months of default, the original seller has the right to come and take back the property title. So that's like most seller finance deals, and this is going to vary based on state. So make sure you work with like a contract law attorney in your state if you're gonna do a deal like this. But out of all the 3 seller finance deals that I know, or that I've done, all of them have this in there where if the buyer doesn't make a payment for an extended period of time, the seller can come and take back the property. But to answer your question, it typically transfers on the closing day. I know I went through this kind of quick. Does anybody else have questions about this? Yeah, most of the time, this is going to be buying property from people that own it outright, or like buying a business outright. Now, you can get a bank to come in and like they can have a loan on the, like, let's say they have, in this example, let's say they had a $100,000 loan outstanding. You'd have to communicate with their bank about how they're going to get made whole, essentially. And it just kind of like muddies the water, because then you'd have to probably come in with your own bank to pay off the old bank. But this is traditionally done when the seller owns the property outright. But it can be done if they have a loan on it. It's a much more complicated process. I've only had to do that one time. The other two times the seller owned the property outright. It is not sub two. Sub two is a whole different ball game. I don't know enough about sub two. I haven't done any sub two deals. It kind of scares me, to be honest. But I have done seller financing like this before. Yeah, there's just too much like uncertainty. I think, especially with where the interest rates environments are. You know, if a bank has a 3% loan out there, and they could take that same money and go get the 7% on it right now, and they have an excuse to call the loan, like, why would the bank not do that? Like, if I see that you have a 3% loan and you sold the property subject to somebody else, and now you're technically in default, and instead of getting 3% on my money, I can get 7%. Like, if I was a bank, I'd call that note and then go get 7%. Yeah. What's up, Parker? Are you in?
Hey, can you hear me?
Yeah, I know you have some feelings about subject to.
Oh, which one? What are we on now?
Well, so I
Oh,
was
on
just
subject to, yes.
yeah, I was just teaching about how to buy a property using seller financing,
Uh-huh.
but we had somebody comment in here about sub two specifically.
Don't do it.
Do you agree though? Like, okay, if I'm a bank and I have a loan and I have a loan out to Josh for 3%, and Josh sells the property subject to somebody else,
Mm-hmm.
and right now, instead of getting, like, right now I could go out in the market and loan that money out at 7.5%. As a bank, why would I not want to call that loan so that I could grab the money and go get 7.5% on it? Am I thinking the right way?
Well, I mean, that's valid. I think that more so though it's the risk. So, when ownership of a property is given away, if that loan were to be defaulted on by the new people or the seller, it's more of a default risk, because then how can they go foreclose on it if the person they are in a contract with to repay the loan doesn't own the property?
Mm.
So it's more of a risk factor, I think, than a greed factor. If that makes sense.
So so in sub two, it's hard for the bank to come after the property because they have to figure out who to come after.
Yeah. The same thing, like, that's why it's a little challenging sometimes with spouses, where they'll want both on if it's a primary home, because it has to do with, like, some states have laws protecting primary homes. If one spouse isn't on there, but they're living there, how can they foreclose on the house. So it's more of a legal ownership versus debt concern, I think, than it is, hey, I can make more money if I can lend this at 7.5%.
Yeah. Another question. Do taxes go up in seller finance since you negotiated a higher purchase price? I would say so. Right?
Yeah, I get what would be recorded. I think it depends on the states. Some states reassess based on sale.
Mm-hmm. Can you cash out refi with that? I think that's the tricky part, right? Like if you do a 5-year seller finance note, are you going to make sure that you have enough, you'd have to have enough equity in there to be able to refinance and get a bank to buy out the remaining balance, pretty much, right?
Yeah. So I guess with the cash out refi, as long as you're paying off the first lien on it, it shouldn't be too difficult. Yeah, I think if you try to get a second on it, that would be hard, but maybe not a cash out.
I think that might answer the next question. Yeah, if you did a 10-year seller finance, your monthly payment, your monthly payment on a 10-year seller finance would be lower than a 5-year. But to your point, I suppose the bank gives me 30 years to pay it. I think that's what I was getting at is sometimes people have deals that a bank won't underwrite. Like if you have a campground or you have a hotel that's losing money, that's negative $20,000-$30,000 a year cash flow, there's not a bank out there that may want to risk being the loan holder on that. And so that's where the seller financing would come in because they can't sell it traditionally on the regular market.
Definitely. Yeah, that makes sense. So it's more in that commercial space. I think that would make more sense.
Mm-hmm.
For sure. And also now, if you have a property that's paid off, I think that's it. And sub two, I'm not saying never do it. Maybe in some situations it's appropriate. It's just something I think people need to be careful and educated about before they do it. Right.
I know this is up to the seller, but how many years is the note for seller finance properties? Most of the time it's 5 to 7 years. Every time I've done it, it's been that. But it really can be anything.
Well, and they can do it where it's amortizing over so many, they could do a 30-year amortization with like the 5 or 7 balloon.
Sure. 30-year amortization, but a 7-year balloon payment. Yeah. Or 7 or 10-year balloon. Because I think that is the challenge with like this seller financing and the sub 2 is what is your exit? Like not exit, but how are you repositioning yourself, right? And depending on what happens to the property or the market, you don't want to be like left out to dry.
And I'd say on that note too, be careful if you're the seller. I had a client call me recently. They're doing a sub 2 as the seller. And they were like, oh yeah, we're getting, $300,000 as a down payment. So even if it goes south, we'll still be fine. And they said that the buyer was getting a wraparound mortgage, like a second lien on it. And so then I had to explain to them, well, you might be getting that 300 now, but what happens if something falls apart with this? That lien is on the property. Even though it's not in your name, that lien is against your property. So if something were to go wrong, you're not going to be able to sell your property without paying off both the first and the second. And they hadn't thought that through.
So the first is their current loan, right? The second is the new wraparound. Is that what it is?
Correct. Secured by the buyers.
Yeah, I think that because that might answer Josh's question because Josh asked earlier. He asked if the seller has to own a property outright in order to do seller financing. Have you guys loaned on deals where the seller still stays in? Or?
I have not.
No.
Not that I was aware.
If I have, let's say, a property that's worth $500K and I still have a $200,000 loan on it, and I wanted to sell it using seller financing, how would that work?
If you weren't, you could maybe potentially if you could get $200,000 to pay off that lien, like as a down payment, that would be ideal. And then you're just doing pure seller financing because there's no lien on it.
Right.
Otherwise, the only way I really know of would be that sub two, since that if you didn't pay off the $200,000 balance.
Yeah. So if you're buying a property, if you're trying to buy a property that still has a loan on it, you'd have to most likely come up with the amount, pay off the loan at least as a down, and then you're financing the rest. Okay.
And if you enjoyed the podcast today, just click on the link below in the show notes and you'll be one of the first to know the next time that I do a tax strategy bootcamp.